Hi everyone, I'm Kat Gregor. I am a tax partner at Ropes and Gray in Boston, and I am back to give an update on the Biden administration's progress in its proposed tax policy changes and the legislative process surrounding the tax proposals that Biden has put forth. Well, we've had about 5 major updates since we last spoke, which is a lot of activity in just a couple months. The first is that the Treasury Department released what's referred to as the Greenbook. So the Greenbook is an explanation of the president's revenue proposals, which include most of the tax increases. And this gave us a lot of insight into the details that the president had previously proposed in the American Jobs Plan and the American Families Plan that he had previously released. In addition to that, we have the Bipartisan Infrastructure Plan, which has made the news a lot lately. That is a bipartisan plan where the president and the administration have come to an agreement with members of both parties in Congress to implement some of the non-tax provisions of the American Jobs Plan, but it also includes one key tax component. In addition, we are seeing progress on the budget reconciliation process, and that will include both Democrats and Republicans negotiating the other tax aspects of the American Jobs Plan and American Families Plan. And then lastly, we've seen a global minimum tax agreement, which is something that is a part of the Biden administration's planned tax policy changes, but one that requires sort of multilateral, multinational cooperation across many, many countries. And we've seen a lot of movement on that in the last couple months. The last thing I would mention is that we're also seeing increased IRS enforcement, both organically without any increase in funding, but also in anticipation of potentially receiving more funding from some of the president's proposals. The Greenbook is really just a more detailed explanation of the Biden administration's proposals. And so there we saw more explanation, but consistently the same concept. So a proposal to increase the corporate tax rates from 21 to 28%, which we previously discussed. Also increasing the maximum ordinary income rates for individuals to 39.6%. Again, that's an increase from a current rate of 37%. And then from there, there was more discussion about the increase in capital gains rates for individual taxpayers, primarily focused on taxpayers with adjusted gross incomes of over $1 million. There, the president has continued to propose that those gains be taxed at ordinary income rates as opposed to the preferential capital gain rates that are currently enforced. That said, it's worth a note that there has been some discussion that there could be a negotiated outcome where rather than increasing fully to ordinary rates, that high income taxpayers actually just pay a higher preferential rate. So instead of going all the way to 39.7%, there has been some discussion in the news that perhaps the political process will settle out at something like 28 or 30% preferential rates if you are a high income taxpayer. In addition, the Greenbook also expanded on some passing references that had been in the American Families Plan that contemplated that all taxpayers should be required to pay self-employment tax on all types of business income. In addition, the Greenbook would expand the scope of self-employment tax to ensure that all business income of high earners is taxed either through the self-employment or net investment income tax rules, regardless of the source of income. And we think that this is a specific reference to certain exclusions from self-employment tax that exist under current law. The Greenbook goes into more detail on some of the international tax proposals that Biden has proposed in his jobs plan in particular. And taken together, these could result in a substantial increase to U.S. corporate tax revenue from non-U.S. subsidiaries' current income. And part of these fit in pretty closely with some of the proposals that are on the table on a global basis, which we'll get to in a minute. The Greenbook would modify GILTI by both increasing rates and eliminating the 10% exclusion for qualified business asset investment income. And so what that really means is that the GILTI regime is going to evolve into a minimum tax across all foreign activities of U.S.-based businesses. In addition to simply increasing the rates and denying a exemption for qualified business asset investment income. The proposal would also deny the use of tax credits that arise from high tax jurisdictions against low tax jurisdictions. In essence, the proposal would look at the tax being paid by US-based businesses on their foreign operations on a global basis to ensure that that global basis would result in a minimum level of tax overall. In addition, there are a couple proposals to replace the base erosion anti-abuse tax with a more expanded anti-abuse provision that would deny multinationals U.S. tax deductions by referencing payments made to related parties that are subject to low effective tax rates, and also would eliminate FDII, which is the foreign derived intangible income rules that provide a reduced rate of tax on foreign source income, effectively royalties from foreign licenses. And at a general level, there is a lot of focus on ensuring a minimum corporate tax rate. The Green Book proposes a 15% minimum tax on worldwide global book income and would look to the largest U.S. corporations with earnings in excess of $2 billion. This is in line, again, with some of the international negotiations that we'll go to in a minute. At a general level, the infrastructure plan shows what we always knew would be the case, that there would be bipartisan support for a lot of the investment aspects of the American Jobs Plan. And again, this is focused just on the jobs plan. There are no components of the American Family Plan that are pulled in. But in essence, the infrastructure plan actually pulls in, with bipartisan support, a lot of the components for investment. So reinvesting in roads, bridges, railways, improving electrical grid, increasing broadband access, water delivery, electrifying public transportation systems, and building electric vehicle charging stations. Interestingly, there are not as many proposals for what we might consider to be green infrastructure. I mentioned a couple, but there have been a lot more proposals in the jobs plan focused on things like develop wind energy and other forms of alternative energy sources. And instead, the plan primarily focuses on traditional infrastructure projects, which seem to have more bipartisan support. The plan would cost $1.2 trillion, which certainly is a lot, but it's a much smaller proposal than the overall American Jobs Plan. And so with that, though, there's only one tax component. The interesting part is that a $1.2 trillion price tag, there's only one source of funding, and that is actually spending money on IRS enforcement. And so what the plan proposes is to pay for all of this infrastructure by actually giving the IRS more money, about $40 billion, to increase its enforcement efforts. And there is a belief that the majority of the spending can be achieved by the IRS closing what is referred to as the tax gap, effectively collecting tax that is being underreported or not reported at all, and sort of seeking enforcement revenues rather than actually changing tax laws. The budget reconciliation is effectively the path that we will look to for all of the Green Book's other priorities. So proposed rates, but also the international tax reform proposals as well. We also expect that, given the nature of the budget reconciliation process, which is very much a negotiation, particularly with moderate Democrats that may not support the full scope of tax increases that the Biden administration has proposed to date, we do expect that the rate increases will end up coming to a compromise position that will not be quite as high as what the Biden administration has proposed so far, but will be something. And so looking to things like corporate tax rates, we expect something in between 21 and 28%. That is consistent with what we've been expecting, honestly, since the campaign. We do expect there to be material sort of political compromise on that number. Maybe something in the neighborhood of 25% is more likely. With respect to capital gains, as I mentioned earlier, there is support for increasing the preferential rate for capital gains, particularly with respect to high earners. But we think that perhaps we will end up with something that is less than the ordinary income tax rate. So again, something maybe like 28 or 30% is a potential compromise position that could get enough support from moderate Democrats and even some Republicans to go through. Interestingly, the 15% minimum corporate tax on global book income is relatively uncontroversial and likely will go through, but a lot of questions remain about whether or not it can be imposed in a way that doesn't just target large US corporations, which we can talk about in a minute with some of the international proposals, or whether it can be implemented in a way that is fair and impacts all businesses globally. And I think once you get to a resolution where all companies are on a relatively equal footing, I think there will be a lot of bipartisan support for that 15% minimum rate. So we're still looking to 2021, and we think the legislature is going to push for this actually to be finalized in 2021. Right now, the president had mentioned that he hopes that there will be a deal both with budget reconciliation and the bipartisan infrastructure plan, but he clarified later that he is not actually threatening to veto the infrastructure plan if there isn't an agreement in budget reconciliation. So we think that we will have a busy month in July seeing the bipartisan infrastructure negotiations go through, and that legislation may be passed this fall, and then the budget reconciliation will probably follow after that. And we'll see those negotiations primarily in September and October.